Pete, so good to see you. We have a lot to talk about today. We are going to talk through 3 financial planning and investment opportunities in a down market, which of course we are in right now. Recently, the US stock market saw the biggest 2-day wipeout in history, $6.6 trillion. In fact, the market has lost 11 trillion since inauguration day. Now, before we get into how to take advantage of this down market, I do want to talk through what we are seeing right now, which you and I have talked about before, Pete. The concentration risk in the market, where 80% of the market's movement due to only 10 stocks. To see that in a different way, this is a look at the S&P 500's 3-month performance. The Mag 7 alone have lost 2 trillion since the start of the year. So when we see this much red on the board, what do we need to keep in mind?
Yeah, it's quite frightening at first look here. But what I do is I remind our clients that they have a diversified portfolio across a broad range of stocks and bonds, not only domestically, but internationally. And by having this diversification, it's going to manage the volatility. You're going to lower the volatility in your overall portfolio because you're not concentrated in those major indexes. I understand, though, watching the news and reading the news, you see these big swings in your portfolio in these indexes, and you're thinking you may have the same type of volatility in your portfolio. Reviewing our clients' portfolio held at Brookstone this year, we're down anywhere from 2 to 5%, which is really showing you why diversification works for the long term, not only in the upside market, but the downside market too.
Yeah. Right. Such a good reminder that the S&P is not a well-diversified portfolio. All right, let's talk about how to take advantage then. Number 1, put your cash to work. It may feel better to hoard all of your cash under the mattress right now, but that really compromises your ability to build long-term wealth. Take a look at this, Pete. And I know you know this, but this is for all of our viewers. That top blue mountain is if you're invested in the S&P. The blue line in the middle is bonds, and the black line at the bottom, T-bills, which is essentially cash.
Yeah, leaving your money in cash, especially if it's earmarked for your portfolio of stocks and bonds, leaving cash, having a cash position, you're going to underperform over the long term in the market. So the sooner you could get that cash to work and invested, the better your overall performance will be over time.
All right. Tip number 2 here. Take advantage of all those stock losses and consider tax loss harvesting. How does this work?
Yes. So in down years like this here, tax loss harvesting is when you're going to look at some of your losses and you may want to adjust your portfolio. Now, remember, when you sell a stock at a loss, you get to take that loss against future regular income gains. The way the law works right now is you're allowed to take $3,000 a year in losses until those losses are used up. So if you have a $10,000 loss, it'll take you about 4 years to use up. Or in years, you may look and see you may have one position at a $10,000 loss and another position that has a $10,000 gain. They're going to offset each other, and that way you have no capital gains to pay for that when you offset it like that there. Yeah. So having those losses, you can use them against all gains as long as you have them until they're all used up.
So nice. There's a silver lining there. And then last, can you explain why Roth conversions often make more sense in a negative market?
Right. Well, Roth conversions, we know, we've been talking about it for years and years. To build a Roth position of tax-free growth is always a good thing. If you're converting in a year like this here, it's even more beneficial when the market's down. For example, you may have a stock position where the share is worth $15, but it's now worth $10. Converting that share right now, you're going to save $5 in regular income. And then after it's converted, you'll get that future tax-free growth on that Roth IRA money. So in years that the market's down, if you're converting, it's going to be better for you. And if you haven't started converting, this is the year you should really start looking at building up some tax-free future growth for yourself.
Can be incredibly powerful. Yeah. Well, Pete, again, I'm so glad we got to talk this through. I feel better after talking with you. If somebody wants to ask you more about these strategies to make sure they are well prepared to take advantage of this volatility, what's the best way to reach you?
Yeah, our phone number is 847-499-3342. We'd love to talk to you, talk about your particular situation, and see what moves will benefit you the most.
All right. Pete, thank you so much for your time today. I really appreciate it.
Thank you, Erin. Bye-bye now.